Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 27th, 2022. Appreciate you all tuning in to this channel and subscribing, as well as subscribing to our podcast InvestTalk, which airs every weekday. Now this week I'm going to title the video Weak Economic News Brings Bear Market Rally. And this is very important to understand that we're in a bear market. But in bear markets, there are often very sharp, swift rallies, often caused by sentiment getting off a side, as well as some economic news to create a catalyst. And the economic news this week has really been the weaker economic data. Now, I say, well, weak economic data, that should be bad for markets. Well, remember, the markets are really driven by liquidity conditions and the Fed changing those liquidity conditions. And obviously, the big drawdown in asset prices over the past 6 months or so has a lot to do with the Fed's shift in policy. Now, the PCE number came in, and this is what the Fed looks at most of all when it comes to inflation figures. Now everyone focuses on CPI, but that's not really the Fed's favorite figure. PCE is one of their favorites, and you see this decelerating in April. Now remember, this is in April. We're almost done with May. So when you're looking at economic data, make sure that you're understanding whether this is kind of old or this is pretty new. And remember, April, if it decelerated in April, economic numbers came in worse in May so far, and that means there's likely even more back-to-back deceleration in PCE year over year. And you've already seen, even without the month of May in core PCE is down 2 months in a row from 5.3 to 5.2, now 4.9. Okay, so that's the market likes to see that. Market likes to see that inflation, the big boogeyman that the Fed is using as a reason to tighten policy. I'm not saying that's good or bad, but that's what they're mainly focused on. So if that is moderating, let's hope, that the market or the Fed will not be as tight when it comes to their monetary policy going forward. And so that's something to look at. Now here's the consumer sentiment, the lowest level since '08. That is more up to date. This is the month of May. So clearly the consumer is worried about inflation, worried about maybe the job market, the war, whatever. When sentiment goes down, that means they spend less, and that tends to ease the pressure on inflation. And then you have unemployment insurance, and let's look at the 1 year, and that is now in an uptrend. So this is the 4-week average. This is kind of the best one to use because week to week can kind of skew the data. Any week can look a certain way, but when you start to kind of create a moving average here, you'll see that has not started to trend up since the beginning of April, so about 2 months in a row, and still from very low levels. So it's not like the job market's falling apart, but it's something to consider, and certainly the Fed is looking at that, although they probably want the labor market to cool a bit so that wage inflation cools a bit. Now the Kansas City Manufacturing Index, that also is this month in May, so coming from 46 to 28 to 19. So certainly strong deceleration here over the past couple of months. New single-family home sales, now this is the month of April. So this is a bit old, but you can see 4 months in a row of declining new single-family home sales. Now this all feeds into the economy and to markets, and the Fed cares a lot about markets, and especially the bond market. And the bond market, remember, PE pal, private equity pal, he focuses a lot on this because private equity is very focused on the bond market and borrowing money and creating leverage. And so if this starts to blow out, meaning investors are worried about the solvency of these corporations, then that's an indication that the economy is going into a recession. We're at 1.44 now. That's not really that high, to be honest. This hit a high of 3.33 in March of 2020. 2016, it hit over 2. 2012, over 2, and about 2.5. So 1.44, certainly elevated from where we were a year ago, but kind of in line with pre-COVID levels. Pre-COVID, right, we were at 1.3-ish. So nothing on that side is causing the market to be too worried. Now let's touch a bit on the S&P. Let's pivot over to the S&P. And what you saw here was a nice bounce off this 382 retrace from the COVID lows. This is Feb retrace to the recent highs, and you got a nice bounce. 382 and the 618, those are typically the strongest support levels, and so not a shock to see a rally there from technical perspective, from a sentiment perspective, and then you had the news to kind of give that catalyst. So you get this strong rally, and the question is, where does this go to? And I think there's two levels. One is right here, this breakdown, top of the breakdown bar from May 5th. And then you have the breakdown level. Remember, you got this pullback, bit of a rally for a couple days, and then failed. And typically, when you fail that major level, and you get back to that level, that's resistance. So those are kind of those two spots that I'm looking for this to rally to. Kind of a minimum, the top of that May 5th breakdown bar, maximum this breakdown right around 43.70. So that's kind of my range that I think that will bounce to. Then the NYSE, remember the broader indices. And if we go back here to the weekly, and let's just run a little fib here. Let's see what that looks like. Okay. So this is broad indices. It did close below. So what this is wanted to tell me is that this does want to go to the 382 retrace and the break up area, right? Where this broke out, oftentimes that revisits that area. And honestly, that's probably where I expect the next rollover in the market, probably in the summertime, to really take us. And so that would be major support on the NYSE. But near term, I definitely think we can get a nice solid bounce. Probably once again, look at the 618 from this recent high to the low, and you get the level right here on 16,400 on the NYSE. And I think that's probably likely where we go over there. Now the NASDAQ, you're getting a nice solid rally, but obviously this is very weak. Look how downward pointing those moving averages are, and that means the trend is not your friend in the NASDAQ. So this is an opportunity if you got burned by some growth stocks to be selling into this rally. I think we get to probably here right around 13,000 on the NASDAQ, and I don't think it gets much further than that. But still, call it, it's nearly 1,000 points. So that's 7-8% higher on the NASDAQ from here. Would not shock me to see that move. And then let's look at the Russell lastly. And this also had, remember I said the break up area where this broke out, and when it returns there, it's support. Well, you had double support here, that area as well as the 50% retrace from the low to high, and you got a bounce. So not a shock to see that from a technical perspective. And now the question once again is, where does this get to? I think right around 2,000 on the Russell. You have this 382 retrace into that 100-day moving average. I think that's going to be major resistance. This breakdown area, I think that's an area where you really want to lighten up on equities if we get there on the Russell. And now I want to focus a little bit on the volatility index. So there's the VIX, but then there's also the VXN, VXN. This is the NASDAQ 100 volatility index. You can see this trending higher. You don't want volatility to be trending higher if you are invested in the particular asset, because typically when that volatility is up there, it means volatility to the downside, put in simple terms. And so you still see that trend in the VIX, but the VIX in the Russell, the NASDAQ vol continues up and to the right. And that means that these rallies, you want to be lightening up your positions. Now, what's interesting about the other volatility index, like the oil volatility index, that was starting to break down. And that means oil is breaking out. See that? See how oil is breaking out? It's just grinding higher. When volatility is relatively low, it's just a grind up. And you've seen that in the equity markets for many years now. Now it's kind of flipped, where it's in the oil market and the equity markets have kind of flipped the other way. That's breaking out. UNG, that's breaking out. DBC, so this is the broad commodity index breaking out. And what's happening? The dollar. The dollar is having a pullback. I talked about this before, as the commodities were very strong in a strong dollar trend. And that's pretty rare. Now, and I said, what happens when the dollar pulls back? You're going to put gasoline on that fire, and that's what you've seen over the past couple of weeks. And same with the agriculture space. That's starting to really break out. Wheat doing very, very well, maintaining its trend. So this is a market that continues to be bad for the Fed. How do you contain the inflation when commodity prices continue to go up? And they're going to sacrifice long duration assets, right? TLT. Let's pull up TLT. Getting a little bit of rally here, but this is the Fed really taking it to the woodshed, and take woodshed to long duration assets because they need to stay in a tightening path. Is it going to moderate a little bit? Probably. Are they going to get to 3.5% Fed funds rate like they've talked about so far by the end of the year? Probably unlikely, but still going from 1 now, 75 basis points to 100 basis points now, to probably closer to 2.5 by year end, which is still tightening policy. QT starts on Wednesday, meaning they're going to roll off assets from their balance sheet, etc. And that typically is not great for asset prices. Now here's, let's go back to TNX. So you're getting this pullback here, but this is a very orderly pullback from an overbought condition. Rates moved very fast, very far. So to see this start to enter probably a consolidation phase is what I'm expecting. Kind of a range, probably between, I'm going to go here to here. What will be interesting is, let's do this. I haven't done this yet, so I'm kind of just doing it with you. From this fib, retrace. Yeah, so, do we, here, let's look right at that line. That's actually the 382 retrace. So do we get this kind of broad range in 2.4 and 3.2? That's kind of what I'm expecting for a while now, until the Fed pivots one way or the other. Maybe they have to maybe they pivot dovishly for a little while, and then they pivot more aggressively later in the year because of inflation. A lot could happen. But right now, you're just continue to see that rotation of growth to value. This is value. When this goes up, value is outperforming, and you're getting this pullback here, just like you got back in March of this year. But this is a longer term breakout from a long trend where growth was outperforming, and so you need to be careful in this market and understand that these counter trend rallies are opportunities for you to rotate your portfolio, to improve your portfolio, get out of positions that are likely to underperform going forward in an inflationary environment, in an environment where interest rates are trending higher, where the dollar is trending higher. So this is very important to understand, and that's kind of my sentiment. So going back to the S&P real quick, probably a rally, another, what are we at, 4150, probably get to minimum 4250, maybe all the way up to 4350, so 100 to 200 points higher on the S&P, but probably not a whole lot more beyond that. So be prepared, be ready, be on the lookout, and have a plan, have a trading plan, have an investment plan, and understand how those fit in your larger context and your goals. So those are my sentiments. I appreciate you all tuning in tonight, and whenever you're watching this, I hope you have a wonderful holiday weekend, and stay safe, but have fun. And a reminder that the contents of this video are for educational purposes only, should not be construed as financial advice or a recommendation of buy or sell security, or to participate in an investment strategy. The views are my own and do not represent those of KP Financial and those associated. Have a great weekend.